Analysis. Credit buyers see more risk ahead as recession fears rise. New York. Rising recessionary worries are seeing some investors lessen threat of their credit's exposure as they brace for an financial slowdown whose value stays noticeably unsure. U.S. bonds had been harmed via rising interest prices and unrelentingly excessive inflation. However, over the last few weeks the market cognizance has shifted extra heavily toward fears that the U.S. Federal Reserve will bring about a recession because it attempts to tame inflation. As pressure in credit piles up, a few buyers are trying to trim exposure to lower-rated credit and purchase bonds of corporations probably to be more resilient in an economic downturn. We will always very own high yield, we're going to always personal some emerging markets, but I think we probable simply want to personal less going ahead inside the subsequent 3 months, 6 months, mentioned Nick Hayes, head of Global Strategic Bonds Strategy at AXA Investment Managers. We need to improve the exceptional of the overall portfolio due to the fact maybe we are heading into a without a doubt unsure time, he stated. This may not be easy, bond buyers said, partly because rising borrowing fees are probable to cut back deliver, which can also restriction buyers' ability to distribute their publicity between secondary and primary markets. Benchmark 10-year Treasury yields, a barometer for mortgage prices and different monetary instruments, have long passed down to 2.99% from around 3.5% on June 14. But the yield spread on the ICE NYSE BOFA/US High Yield Index, a usually used benchmark for the junk bond market, has gone up by way of over 50 basis points over the equal period, and its investment grade equivalent has additionally expanded. Credit spreads generally widen when risk of default rises. High-yield spreads hit a 2-year height of approximately 600 basis points in advance this month. The Fed has in no way hiked prices with such tight credit conditions, BOFA strategists stated, noting that in each the 2012 dot-com collapse and the 2008 monetary crisis, the Fed becomes slicing rates. Still, high-yield spreads aren't displaying the level of pressure in some earlier crises. Spreads widened to extra than 2,000 basis points all through the monetary crisis and to over 1,000 basis factors in early 2020 in the course of the begin of the coronavirus outbreak. For Jonathan Dunsing, head of Constant Earnings, U.S. portfolio manager at Amundi U.S. Asset Management, credit spreads point to a monetary slowdown, even though now not an intense one, but they could widen in addition. We're nevertheless a touch bit more careful on average publicity, deciding on the groups that we feel are going to be satisfactory located to maybe face up to the imminent environment, he mentioned. Recession signals. Meanwhile, recession signals are getting extra stressful. Some Wall Street banks in current weeks raised their expectancies of an financial downturn, and the inversion of the U.S. 2-year, 10-year Treasury yield curve, broadly visible as a precursor to recession, has grown to its widest given that 2000. What's unusual approximately this slowdown, is that there are shock absorbers suggesting that it might not be a totally deep slowdown if it happens, stated Victor Hajort, international head of credits method and desk analysts at BNP Paribas OTC, BNPQY, regarding factors such as businesses being in proper financial fitness as they come out of the COVID-19 pandemic. Still, it could be extended via the Fed's loss of ability to help because the vital bank is restricted through inflation, he mentioned. A combination of higher interest costs and monetary contraction may want to lead to more defaults among U.S. companies, and an adjustment of investor positions which could, in its flip, hamper businesses' access to the debt markets. There's no doubt that default costs will growth. It's just a question of by how a great deal and how quickly, mentioned James Gellert, CEO of analytics organization Rapid Ratings. Debt bankers say markets are still open for borrowers inclined to pay premia, but that issuers were considering replacing bonds with short-term contraptions or decreasing the dimensions of their fundraising physical activities. For agencies that can't have enough money to put off their investment plans, the direction has become unsure. If the brand new issue aspect of it isn't there, then trying to find secondary bonds may be tricky, said Dom Holland, head of U.S. enterprise improvement at Ledger Edge, a distributed ledger-era corporate bond trading platform.